Hey everybody, welcome to another episode of The Remote Real Estate Investor. I'm Michael Album, and today I'm joined by my co-hosts,
Tom Schneider
and Emil Shore.
And on today's Weekend Wisdom, we're going to be talking about some of the different time horizons to be thinking about with regard to your investment. So if you need the money sooner, should you be investing it in real estate? Do you see it as a long-term growth vehicle, or is it something that you're going to need in the more immediate future? So let's get into it. So guys, we were chatting before the show. Pierre brought up an amazing question he's dealing with right now with his family that he's investing with. They are looking at investing money into real estate. And someone brought up the question of, well, the kids are going to college in a couple of years. Should we be investing this money in real estate? What is the different time horizons that we should be expecting for real estate investments? So, Emil, I'm going to kick it to you first. If you are planning on using a chunk of change in 3 to 4 years, you know you're going to need it for something, whether it's a new purchase, a car, kids going to college, kids going to school, what have you. Should you be investing in real estate? What are your thoughts?
Personally, I look at real estate only as long-term investing. So if I was looking at something 3 years down the line, I would not take that money and put in real estate personally. Everything I buy, I am thinking about in terms of at least 10 plus years. So,
and what are you worried about in that 3 to 4 year time horizon? Why wouldn't you put it in real estate?
I just
the last couple of years, the market's been on fire.
Yes, it has. But it's always hard to predict, will that happen? Just with real estate in general, my thought is on a long enough time horizon, it is much harder to mess it up. I want to mitigate risk and do as good of a job. And you walk into properties thinking like, oh, my spreadsheet math tells me I'm going to make this much per year and blah, blah, blah. In reality, things happen, things break, you have down years. And so to know that it's only going to be 2 to 3 years, it's very possible that could be a period where either A, the market goes down, we have some significant capital expenditure where cash flow for the year is negative. So you're losing some value there. So for me, I think 2 to 3 years, especially this is more of like side hustle, quote unquote, right? I don't do real estate investing full time where I feel like I'm a pro and all that. So just for me personally, where I'm at in my career, I wouldn't take short-term money and put it in real estate and be like, all right, I'm going to get out in 2 to 3 years. Plus, when you sell a property, you're typically paying 5 to 6%. So even let's say you have 5 to 6% appreciation after you sell and pay your commissions and closing costs, all those things, a lot of that could just be vaporized. So I like holding for long term.
Emil, I've got a follow-up question for you though on the timeline. So let's kick it out to a 10-year time horizon. Let's turn the clock back to somebody investing in 1999. They have a 10-year time horizon. Now 08 hits. They're planning on selling in 10 years and they just get decimated. 08, 09. Doesn't the same risk factors apply 10 years down the road that we could be in a down market by the time you're looking to sell?
Totally. To that, I will say though, that if you look at historical price charts, I've done this. You look at 2008, that was an anomaly over 60 years, right? I think there's crashes, but a crash of that magnitude is very rare. Again, look at chart, look at price value, average price value across the country. There's times where it goes flat or dips a little bit, softening, but just a cratering like that is so rare. So you could have that mentality, oh, we could see another giant crash, but my thought is that they are pretty rare in one's lifetime. The fact that we had one in 2008, I wouldn't expect to see something of that magnitude for a long time, but that's just my opinion, not advice or anything.
Yeah, and also that's crashing everywhere. That's not just real estate. That's your equity,
the financial markets,
the whole financial market. So it's not like you're escaping it in one avenue versus another.
Well, if I put it in my bed, I'd have more money.
There you go.
Yeah,
but stock it away in the mattress. No, that's such a great point, Tom. But same question over to you. 3 to 4 year time horizon. Are you putting your money in real estate?
With a 3 to 4 year time horizon, I would probably put it in an index fund. Real estate, I think, is a better 5-year marker, and to think of it just because of that really great point Emil made earlier about there are some transaction costs and frictions. I think a lot of it also is your risk tolerance. I'd say I'm pretty risk tolerant, but with that said, though, like where I'm taking my risks are pretty tried and true paths. Actually, I'm going to contradict myself. Just bought my first little bits of Bitcoin, little slivers of Bitcoin. So pretty excited about that. I'm in the digital currency world. The remote digital currency buyer. That's going to be our new podcast. We're gonna ramp up. Okay. So back to the question. 3 to 4 years. That's a little bit tight. So I mean, I think 5 years is a number that I would feel better about. But I could see if the deal was appropriate. Like I could see shrinking into like a 3 to 4 year horizon. But it starts getting a little bit thinner when you start accounting for those transaction costs.
Makes total sense.
What do you think?
So, yeah, I personally probably would. I feel like that's probably not grammatically correct, but I would go purchase a smaller value add deal and look to reposition a building at that point in time. Because a 3 to 4 year time horizon to reposition a small property is very doable. It's very reasonable. If it were my first deal, probably not. But the fact that I've done it a couple times, I've been able to, and this is not me tooting my own horn, but double building values inside of about 18 to 24 months, just with some value add repositioning stuff. So that is absolutely a great investment in my opinion. But Emil, you bring up such a great point of the closing costs and the commissions just eat away so rapidly at your profit. I mean, even if you buy something under market and try to turn around and sell it, the commissions, closing costs just eat that up so quickly.
And so capital gains, right? If you need that money, you're going to be using it. You also have to pay capital gains tax. So
right. So your true gain it becomes much smaller very quickly. Tom, go ahead.
To follow up on your point on doing value add stuff, I mean, when I think of value add, I think of a little bit higher beta, as in like kind of higher highs and lower lows. And, if you have such a short time horizon, I would think you would want to do something safer. Counter argument. Come at me, Michael.
Let's go debate.
Yeah. I think that when you look at cap rates, and I'm talking about multifamily value adds because multifamily trade based on cap rates. So if you look at adding value to property, and we can do a quick example. Let me get my calculator. If you go buy $150,000 multifamily property, 5 units, and you are able to add, let's see you buy it at a 6% cap rate, which is a fairly low cap rate for that price point, I would imagine. So what that tells me is that $150,000, that property yields $9,000 in annual NOI. So let's say it's a 5-unit building and you're able to manipulate the value and you add a $25 bill back to every tenant. So you change nothing about the property except adding $25 to every tenant utility bill, which is 25 by 5, $125 a month. When you multiply that by 12 months, that's $1,500 that you've just now added to that NOI. So now your building NOI is $9,000 plus $1,500, which is $10,500. If the market hasn't changed at all, you should be able to sell that building at the exact same cap rate you bought it for, a 6 cap. So when we take that NOI, divide by our cap rate of 0.06, we get $175,000, which means that there's $25,000 in profit to be had. But per Emil's great insight, we need to be paying closing costs and commissions. And at a 6% commission, we're paying $10,500 in closing costs. So our 175 gets eaten down to, what is that, 165, 164 and change, leaving 14,000 in profit, 15K in profit, 14K in profit, and then another 2 in closing costs, so 13K in profit. So you'll pay probably 25% on those capital gains. So 13K times 0.75. You'll walk with about 10,000, 9 3/4, and 10,000 after a year on your initial investment, depending on what that is, could be a great return, could be a less good return. But this was just a real quick and dirty example of doing a minimal lift of a $25 utility bill back. Now you add some additional dollars in there and doing rehab, and you up the rents by $100 a month. that might be $500. So that's $500 per month. By 12 is $6,000 a year. Now that takes our NOI up to $15,000. Again, divided by that same 6 cap, that's $250,000. So you added $100,000 in value by manipulating every unit by $100 a month, increasing the NOI. That
I dig it.
is absolutely worthwhile. And I think that the returns on that you would be blown away.
I dig it. I guess when I hear you say value add, I always think of like, going into the walls and doing stuff. But like what you're talking about is more of just optimization of the rent and like maybe bringing up to market rent.
Exactly.
I think getting involved in some big project, if I had a time horizon that I like needed to get the money back and it was like the money was accounted for, do you know what I'm saying? That's a good example.
Yeah, I think you have to be really strategic around what type of value add you're willing to take on and the time horizon. Like my development project I'm working on, redevelopment project, we've been in it now for 2.5 years. So there's no way that would be on the table for, that 3 to 4 year time horizon. But a smaller project absolutely could. Absolutely could.
You also brought up a good point in that if you're thinking you're going to do this right on the first one, don't delude yourself. Like probably get 1 or 2 under your belt as like test cases. And then you can be like, you know what, I can probably do another one, get out in 2 to 3 years and feel like you'll be successful versus like, I'm going to learn everything on the first try and try to make some money on that too.
And hope it goes
gamble.
well.
Yeah.
Yeah. Well, you're gambling on that deal, but you're also gambling on whatever that dollars are earmarked for. So if that's your kid's college fund, you have to say, hey, sorry, the deal didn't go as planned. My bad. But
my bad.
But so Tom, kind of to your point and your strategy, would you feel comfortable putting that money into the stock market in an index fund with that same time horizon? Because I mean, same issue applies where you could lose the principal.
Michael, did you just throw back on me what I threw at you?
I may have.
I mean, again, this is not like investing advice, yada, 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 all of that. I mean, the safest thing would just to you could put it into a CD, but that's like not very fun.
It's your kid's college fund. It should definitely be fun.
It should definitely be fun. Yeah, put the fun in fund college fund. No. I mean, I would feel okay taking that, putting it into an index fund. I'm not like playing the penny stocks, like just betting. Some big. I'm not going to say the name of the funds because I don't think we can, but just some big index fund that covers the stock market, and with low fees. And let it ride. That's actually what I've been doing recently with my rental income that I've been collecting on my portfolios, where before I had it sit just in cash. And now I've been really aggressive about moving it into an index fund. And it's like already like meaningful income, like that's like growing. And for sure, like it puts me more at risk to fluctuations in the market, but I'm in a position to be a little bit more pro risk in my life right now. So that's my answer. Yeah.
Yeah. Makes total sense.
To add there, I think it probably depends on what this cash is for. If it's like you want a nice sports car in a couple years, you lose that money, you can get another car. If it's your kid's college tuition, maybe just play it a little safe, right? Like it's pretty damn important that you don't the value doesn't go down so that you can pay for your kid's college, which is important. So I don't know. That's one other thing I would factor in here is like, what is the money going to be used for? How important is it that it does not shrink at all?
Yep.
It's a great point. But then so doubling down on that question, let's say you get this slug of cash and there's no more cash coming and you have to grow it into something in 3 or 4 years for your kid's college fund. What do you do with it? How do you play it safe yet still grow it?
The boring side of the spectrum is just some certificate deposit, or where the extreme is, I don't know, penny stocks.
This is very simple. You go to Vegas and you put it on black. That's how you do it.
Easy decision.
Double, triple, quadruple your money immediately. Walk away with college fund in hand.
Literally in 2 seconds, you can double it. You don't have to think about it, or you'll go home crying one way or another. But hey, you don't even have to think about it. It's just one decision.
Either way, it's easy.
Yeah, it's easy. No, that's a good question.
little Johnny's going to learn something regardless. You know what's fun about this episode is we all had kind of different, I guess me and Emil were more in the same camp, but we had disputing opinions on what to do.
Yeah. We need more of that.
Just goes to show
we have
you
too much
there's-
groupthink here.
Yeah.
Yeah. Why don't you guys get some individual ideas, huh?
Embrace debate.
I think that's something that they're experiencing a lot, is that they talk to a bunch of different people and everybody has a kind of disputing opinion on what they should do. And then they find themselves kind of paralyzed by all of the options because everyone swears by their strategy.
Are these all people that have done what they're looking to do? Do you know?
There's different financial planners and stuff, different people that are in the finance world or people that are employing the different strategies. One thing that I told them, take a step back and take the big picture view of the finances that they have available. And then maybe make a partition and say, like, this is the money that we absolutely need. And this is what's left over. And this is what we can deploy towards, real estate, so that you can get the balance of both the short-term returns that are going to be liquid in the time horizon they need, and while they're still looking towards the long term.
I think that's great. I think that makes a lot of sense. Go ahead, Michael.
I was going to say, I think another strategy I was thinking about before we started talking about this is just splitting your funds, maybe in half, and say, okay, I'll put half in the stock market and keep half in cash. So if things go great, well, there's some upside there. And if they don't go so great, I've still got some cash. I'm not up a creek without a paddle, so to speak. That might work for some. That might not be a reasonable, the tough, being in the tough spot of, hey, I've got this slug of cash. I have to make it into more. How do I do that in as safe a way as possible, yet still hitting my yield goals or my end value goal? It's tough. And I think it can be different for every person. And there are different ways, as we were just mentioning, to approach it, and probably multiple right ways to do this. At the end of the day, whoever is right is only going to be known at that 3 to 4 year time horizon. So pick a strategy that you believing in, that you're informed about, and then just go do it.
There you go. It's the one that you feel the most confident that you maybe you have some edge with something, right? Like maybe you just know tech companies really well and you're good at tech stock investing, whatever it is, or you invest really well in real estate, you have good options available to you, or you have a business where you can put that, invest that money in a business and make it double or triple, whatever. Just like, what is the best avenue that you believe you'll get to be able to like grow that money?
To complement this episode again, wow, really nice little full circle back here to this, and a nice little bow you put there, Emil. Very, very nice. Yeah. Know your risk tolerance, know your strengths, know your weaknesses, and go Bears. Yeah, that's great.
Well, now that we've got that bow tied up all nice and pretty, should we get out of here?
Let's do it.
Thanks everybody for listening. That was our episode. Hopefully this was helpful. Hopefully this begs you to ask some more questions, have some more hard conversations, and be thinking about things looking into the future. As always, feel free to give us a rating or review, wherever it is you listen to your episodes, and we look forward to seeing you on the next one. Happy investing.
Happy investing.